Good evening, everyone, and welcome to tonight's webinar. My name is Anthea Hotzenberg, and I'm very excited to be with you all here this evening. I'll be doing a couple of things over the course of this evening, especially at the start, accepting people as they arrive in for the call. But we've got a packed room tonight, virtually, from all over the continent and also the world. So a big welcome to everyone. Thank you so much for joining us. I'm so happy to have you all here with us this evening. As mentioned, I'm Anthea Hotzenberg. I head up platform and community here at CatalyzU. We're expecting a few more people to join, but as they do that, we're going to kick right off. We have a hard stop at 8 p.m. East Africa time in Nairobi, where I am, and 7 p.m. in South Africa. So we're going to carry on with tonight's event. Firstly, I'm going to invite all of you to please introduce yourself in the chat. Just tell us where you are joining from. As I said, I'm currently in Nairobi. It is the long rain season, and right outside here, I can definitely hear it. But please tell us where you're joining from, just who you are, your name, and maybe what you do, and then where you're joining from. That would be very cool to know. We have a couple of things before we jump into the conversation for those who've just joined. I'm Anthea Hotzenberg. I head up platform community at CatalyzU, and I'll be your host this evening. A little bit about CatalyzU. CatalyzU vets, trains, and places Africa's leading non-technical talent into the global startup and VC ecosystem. And we are the host for this evening, and we are very excited to be bringing you this conversation tonight. A bit of housekeeping before we jump in. So first things first, this is a Zoom call. I think we've done a few of these over the last few years. You can decide to keep your video on or off, up to you completely, but please always keep yourself on mute. If you drop off at any point during the call, I know some of my colleagues are dialing in from South Africa where load shedding is a thing. If that happens and you get disconnected, feel free to join again using the link that you joined originally. If you're having any technical issues, we have quite a few people on the chat from the CatalyzU team. Your primary contact is going to be Benjamin. So if you have any issues, whether it's you can't hear, you can't see, things are stuck or whatever the case may be, pop Benjamin a message directly into the chat. And then, like I said, we have a hard stop at on the hour here. And if you need to drop off during any point of the call, we'll also be recording this, so you will be able to get access to the recording after this. As introduced, CatalyzU vets and trains Africa's leading non-tech talent, and I'm very excited to introduce our next or our newest fellowship, which is the How to Startup Fellowship, which has just gone live and is now currently accepting applications. The How to Startup Fellowship is a collaboration between CatalyzU and Future Africa. And for those of you on the call, you'll probably know Future Africa is a VC fund and one of the earliest investors in Move, which recently closed $100 million round led by Uber. And in this program, in the How to Startup program, fellows will have the opportunity to learn directly from some of the most accomplished founders and investors on the continent. These industry giants will be delivering live lectures throughout the program, sharing and drawing on their practical experience of building high-growth companies on the continent. Two of our notable lecturers include E. Nolua or E. Aboheji, who's the founding partner of Future Africa. He is the only two-time unicorn co-founder on the continent, Flutterwave and Andela. And under his leadership, Flutterwave became one of the fastest growing payments businesses globally, processing billions of dollars in transactions. Joining E is Mia von Kushitsky-Kimani, who is the managing partner at Future Africa. Mia also has a unique perspective on the African startup ecosystem and understands the challenges and opportunities that startups face because she's been there herself. She co-founded a successful startup that was ultimately acquired by MasterCard. These are just a few of the incredible instructors you'll learn from on the How to Startup Fellowship. It kicks off in May, so we're just under 3 weeks away from the first lecture. If you are interested, applications are open, as I've mentioned, and you can apply either by visiting us at CatalyzU.io, or you can scan the QR code on the screen now. On that note, I'm very excited to kick off tonight's conversation. Tonight's event is going to be all about unpacking traction and growth metrics. I've got an excellent panel of speakers, and really what this is about for us is we are offering a series of masterclasses where we delve deep into the metrics that matters to VCs. So whether you're a seasoned founder or you're just starting your journey, the series is designed to equip you with all the insights you need to succeed. Each of our webinars delve into different aspects of VC metrics. Our first one looked at the core metrics that VCs care about. Tonight's webinar will focus on traction and growth metrics. The third one will focus on financial metrics. And then the final one will focus on industry or sector specific metrics. If you are interested in the other two, you can sign up and we'll share that link in the post-event email. But I look forward to welcoming you all over there. As mentioned though, tonight's one is focused on growth and traction metrics and really the metrics that VCs prioritize when making investment decisions. On that note, I'm going to welcome all of the panelists tonight who's going to be joining me in the conversation. And I'm going to welcome Geordie Kay, Senior Investment Associate at Terra, Karen Serem Waitaka, Chief Investment Officer at Catalyst Fund, and Alioune Blondine Diop, Senior Investment Associate at Loft Inc. Capital. Welcome to you all. I'm going to start by asking you to please briefly introduce yourself. Let's start with Geordie Kay, and then we can take it from there. Geordie, over to you.
Perfect. First, thank you very much. Are you able to hear me clearly?
I can hear you clearly. There was a bit of feedback, but I will resolve that, not to worry.
Perfect. I believe it's fine. So thank you very much. And very happy to be with everybody today. So my name is Geordie Kiongebeni for the people that are a little bit curious. So, so I'm Senior Investment Associate at Octera Capital, so early stage VC fund based in Lagos. We are early stage VC fund with a sector agnostic approach. But we do like to say that we invest in companies that are solving structural problems in Africa. I don't need to speak that much about the structural problems that we have, and I believe that this video was also a summary of one of them. But always happy to invest in new companies, in founders that are dedicated to change the narrative of the continent. So we have been investing in 15 companies since inception. I'm based in Lagos, Nigeria, but we invest everywhere in the continent, but also in companies that are based out of the continent, but with a huge footprint in the continent. Thank you.
Fantastic. Thanks so much, Geordie, and welcome. Looking forward to delving into the conversation. Next up is Karen. Do you want to briefly introduce yourself?
Yep, sure. Hi, everyone. My name is Karen Serem Waitaka, and I'm the Chief Investment Officer for the Catalyst Fund. I am currently in Johannesburg for the Africa conference, and I live between here and Nairobi. Catalyst Fund is an impact VC fund and accelerator, and our focus is investing across Africa into solutions that we feel are supporting communities or businesses better adapt to the negative impacts of climate change. So we invest across different pillars with a climate adaptation and resilience lens. So looking at insurance solutions or agriculture solutions, energy, water management, climate data, carbon credits, healthcare as well, with the underlying criteria that each of these have to be supporting these communities to build that resilience against what is currently happening in the world actually, but hardest hit in Africa itself. It's a pleasure to be here and looking forward to the conversation.
Fantastic. Thanks so much, Karen. Final speaker is Alioune. Alioune, do you want to briefly introduce yourself?
Everyone, Alioune Diop, associate with Lofty Inc. From Senegal originally, with Lofty. So we are Pan-African seed fund, offices across Africa, so in Lagos, Cairo, Nairobi, and a small representation in Abidjan, on our Francophone office, which I'm leading. At Lofty, we invest in tech and tech-enabled businesses solving for the everyday economy. Happy to go through what the everyday economy is. And yeah, we're happy to be here.
Fantastic. Welcome to you all. I'm going to jump straight in and going right to the top. So starting with you, Geordie. We are talking about traction and growth metrics, and really it's important that we start by just demystifying what exactly we talk about when we talk about these metrics. So tell me, what traction metrics do you prioritize? when evaluating startups?
Yes. So I believe that it's very important to speak about the two metrics, but also why. The first one that I'm looking at is the revenue, of course, and I'm speaking about the revenue. I'm not speaking about the TPV or GMV. It's really important to say that because sometimes we don't have the same definition of those different terminology, but because we invest in companies that already are, let's say, post MVP, we want to identify if the company have a product market fit. The best way to have it is to be able to generate at least some revenues. I do prefer to look at it in local currency. Why? Because we are all living in the continent. I mean, at least a lot of people are living in the continent. So we are able also to understand the different currency fluctuations. So I'm based in Nigeria. I know how some companies has been suffering with the different fluctuations. So it's always great to look at it in local currency. The second one is the number of clients, so that it can help me identify what do you chase. Are you chasing, let's say, scalability in terms of numbers? Are you also chasing, let's say, to have clients that you can retain and that are paying for your solution? And it will also help me to identify if the company has been able to, let's say, scale in terms of number of clients, not only, but if the company is able to find the different people that are ready to pay for this offer. The last one, I would say, is the burn rate. So the burn rate will be, let's say, the sum of the OPEX of the company during 1 month. Why I like to look at it is that it will help me, and I have a very boring corporate finance background. So I really stick to the numbers, and it will help me identify if there is any, let's say, resources that you are using that can be optimized. So I will give you an example. If you are a company that is pre-MVP, that is developing something that is not related to any financial products, if you have a CFO, I will wonder why you have a CFO, so that it can help you understand a little bit more about the business of the company. So if I have to choose only 3 metrics, I will choose those ones.
I want to ask a follow-up question on the first one. So revenue, two terms that we throw around quite often, especially in SaaS and B2B startups, is MRR and ARR, monthly recurring, annual recurring. Very briefly, what's the difference between those two? Obviously timelines, but really, like, what's that story? What is the story that it tells?
Okay. So monthly recurring, if you are very attached to the world, would be, let's say, I know that in January, I'm able to collect out of the 10K that I'm generating in terms of revenue. I know that 5K or half of it is from clients that will come back. Doesn't mean that because I have 10K of revenues, this is 10K recurring revenues. So if you want to be very objective, you will take those 5K. What I've been seeing is that a lot of founders, and which is also, I can understand that, they will just take the revenue of the last month and say, okay, this is my monthly recurring revenue. So you need to be very clear with the business model of the company, because sometimes you will have clients that will just come for a time of, let's say, service. So on the IRR, I've seen a lot of companies doing, let's say, the last revenue that you have in the previous months, and you will just multiply it by 12. This is not the way that I will look at it, but I will accept this definition. So this is why I'm always asking to people, what is your revenue? I understand the rationale about the MRR. I understand it also about the IRR. And after that, I asked the question very candidly, like, okay, can you define it to me? But I really stick to the revenue. And after that, I can speak about the GMV, different things, but just so that we are all speaking about the same things.
I think one key takeaway for me is around whether it's annual or monthly is essentially that predictability element, which is also part of the story of, you know, a startup's growth or a startup's traction. I want to move on to Aliyun and then come to you, Karen. So let's maybe just touch on a little bit on the customer acquisition side, right? So we spoke about revenue, we spoke a little bit about burn. Aliyun, specifically for you, from a customer acquisition perspective, what are the key metrics that you look at, and what is the story that that tells you from a startup perspective?
I mean, of course, you can speak about specific metrics around CAC, so customer acquisition cost. You can speak about sort of customer lifetime value as well. Usually we use ratios sort of to tell us if the company is able to acquire customers profitably and basically generate positive returns out of those customers, which is basically the question is, do you have a business? Because if you're paying more to a customer that how much they're bringing you, you know, I would question if you have a business. But ultimately, I mean, I like to see it on a full P&L perspective, to be honest, because ultimately definitions and metrics can tell whatever you want them to tell you. And as Jordi was mentioning, it's very key to align quite early on definitions, right? Some folks, I mean, we've seen funny things in this ecosystem now. People, for instance, I don't know, not accounting for marketing spends within your customer acquisition costs, etc. And I think like beyond like scrutiny, founders need to see it as a way to keep track of their business. It's more that. So we're not asking these metrics or these questions, I guess, to trick. But I guess the first filter is really to understand if the founder themselves understand their businesses. And honestly, ultimately, a P&L, I think, is still the best way to understand the business.
Thanks, Alioune. Just to wrap up there then, so Alioune mentioned two key metrics. The first one was cost per acquisition. And oftentimes founders don't understand all of the cost that goes into or that's incurred when you acquire a new customer, a new user. So very important to keep that in mind. Alioune also mentioned customer lifetime value, which is essentially estimates the total value of a customer or the total value a customer will bring to a business over the entire duration of their relationship. So we've covered revenue, we've covered burn, we've covered customer acquisition, we've covered customer lifetime value. Karen, want to come to you. Any other specific metrics that you want to draw to our attention, and also why it matters to you during the investment process?
Yeah, I think I agree with Jordi and Alioune as well. So revenue, of course, is very important because given the stage at which we invest in, which is a pre-seed stage, it's important for us to know that you're already past that proof of concept or idea stage. There's a willing buyer for your product or your service, and someone is actually paying for that, whatever it is you're trying to sell. So revenue remains quite key for us. However, we have invested in some companies that are pre-revenue. For this particular one, some of the things that we're looking at is signed engagement letters where there's already an off-taker with a price attached to what it is that they're off-taking. So we know that it's only, once we've invested and they've either put in the team in place that requires to produce a service or to assemble the machinery that is going to start generating revenues, it's already clear when that revenue generation is going to happen. Another metric that we look at is that runway. So if you're putting in money now, how long will this last? How many months is it going to last? Is it catalyzing anything within now and increasing your runway, or is this all going to salaries? So again, back to Jordi, we look at burn rate. Are we funding a lifestyle, or are we funding a business, and how that's going to grow? So runway also comes in quite handy for us. Another one, because we are impact investors, we have to look at certain impact metrics. Are you touching on our target market in terms of from an impact perspective? If you're looking at an ag tech solution, how many farmers are you currently working with? How many of those are actually paying? So not, okay, we've signed up 100,000 farmers on our app, and I know for sure perhaps that the farmers are not actually going to be actively using an app. How many are actually active? How much are actually paying for the service that you're providing? What does it cost to acquire that farmer? Are you going directly to the farmer, or are you going through different aggregators and that? Another metric we look at, given that we are a VC fund, of course, so we have to have an upside potential for our investment. So we do look at a valuation range. For Catalyst Fund, it's usually quite fixed. But then we want to see what that potential upside is going to look like in terms of exit potential. So we start thinking around very early on certain multiples, what applies to that particular sector, what is the potential upside for this, similar companies that we're investing in that have already can show some traction and can show evidence that this is something that we're able to grow. There's a slide that a lot of startups use, and I'm sure someone is going to shoot me for saying this, the market, the TAM, SAM slide that I know you have to put it, but it's not, that slide does not sway me one way or another in terms of making an investment decision. Yes, it's a $10 billion market, and you saying that you're going to cover 50% of that market, and within a year, you'll be earning X, is be realistic as well. So we look at very realistic. It's good to know the market potential in terms of, yes, there's a market for this, there's a gap. This is a potential for that gap, and this is how we're going to be solving the gap. And so we can almost quantify what that growth path looks like. But let's be realistic as well in terms of market penetration, market share, when we're looking at that. So impact, revenue, traction from a user perspective, and that the market, we do our own research as well on that. And then, of course, the valuation and exit as well.
Love that. Thanks so much, Karen. For those of you who don't know some of those acronyms, so TAM, total available market, SAM, serviceable market or addressable market, and then the last one here is serviceable obtainable market. I know that slide. I've seen it many times, and I think you all have as well. Thank you so much. Quite a good wrap up there, especially around the impact metrics, which was going to ask around that. So I'm going to move on now. Alioune, coming back to you. Given that we're still experiencing somewhat of a funding winter, we've seen the Q1 results now come out for the total amount raised for African startups in Q1 of this year, significantly lower than previous year. So keen to understand from you, how should founders think about their growth and traction, specifically or particularly their growth projections, and balancing short-term growth targets with long-term sustainability in a tough funding market?
I guess I just want to start with echoing what Karen was saying around being realistic on growth projections. Because ultimately, and I know it's always hard when you build a pitch deck because, it's mainly a marketing document, right? Or something you're trying to be catchy with. But ultimately, when we get down to the business, we need to be realistic, and especially around the funding. Like you mentioned, the funding winter. I think something we probably all filtering for right now, and we being like VC funds, VC investors, is first the ability of a business to become sustainable in the financial way of it, so being profitable. And I'm not only talking net income, I'm talking cash flow. That's one. And second, really when founders are pitching their big vision, I'm always trying to understand how much capital will they need to raise to achieve that big vision, and will they be able to raise that amount of capital to reach that. So when building projections, I would say it's not when building projections, it's when building your business really, and thinking about your business. Find ways to become sustainable quite early on. Find ways to align sort of your short to medium term growth targets with the big vision, but without being too optimistic or unrealistic. And ways to do that very concretely is basically to have some sensitivity and scenario analysis. That's one. And that can even be around fundraising, right? We've seen quite interesting founders coming at us with scenarios, honestly. I don't know, if I'm raising X amount, this is what I'm going to be building over the next 24 months. If this isn't successful, show me that you can still build a business. Otherwise, what end up happening is that the feedback that you'll get from VCs is that come back when you have a lead, and that basically means comes back when the round is almost closed, and that doesn't help you. That doesn't move the needle, right? And that's the way to answer to that is to show basically that over the short term, you can execute step by step in order to reach that sort of big vision. Yeah, that's how I'd go about it.
I think one thing that we hear consistently on all of our events from all of the experts is, these questions around, are you building a sustainable business? Do you have, the fundamentals in place in terms of managing cash flow and a burn rate that's realistic? So again, just reiterating that it's the fundamentals of building a sustainable startup and not just relying on the fundraising realm. Alioune, I have a question for you from the audience, which I think is also quite a nice general one, which is from Midu. Midu wants to know, I'd like to know whether the mentioned KPIs or the metrics that we just mentioned will be the same for all businesses, or is there any kind of adaptation amongst industries? Alioune, I'm going to pass that one over to you. So I think even at a high level, what kind of becomes more important over others if you're looking at specific industries?
I feel like the metrics that we mentioned so far are honestly quite broad and generalist. These are things that I would look at across stages, and probably like in today's market from pre-seed, because I'm seeing very little pre-seed, pre-revenue startups raising at the moment. So these are probably things that I would look here at across across the ecosystem and across sectors. And of course, being specific, and hello, Midu, I think I know who it is, and I think I know about the specific of the business. But ultimately, for instance, if you're building, I don't know, around media, media tech or sport tech or whatever, indeed, I would also look at more specific metrics. I don't know, for B2C media businesses around, the average revenue per user, things like that. But ultimately, you need to understand as a founder building in a specific industry that you're pitching, like you're likely to pitch to generalist VCs. And generalist VCs tend to, analyze the business or analyze businesses with the same lens to start with. So you'd be benchmarked against generalist startups and these metrics to start with.
Yeah, I think also Karen mentioned earlier some of the sector-specific metrics that they look at from an impact perspective. Midu, I'm also going to invite you to join our last webinar in this series, where we're actually going to jump into very industry-specific sector metrics. I'm going to move on very swiftly. I want to come now to Jordi. I think one of the things that we know, oftentimes, Karen made this joke earlier that we're funding a business, not funding a lifestyle, is that oftentimes we have founders that put together these pitch decks, and it's super ambitious because, they're pegging their growth at all costs, or blitz scaling in a sense. So keen to understand from your side, when it comes to this growth at all costs kind of mentality, from a founder's perspective, and really their commitment to achieving high growth. How has this played out in the African market? And then also keen to hear from you, what are the pros and cons to this doggedness commitment to high growth?
First, I just want to say also that please, founders and innovators, it's your job to be optimistic, and ours to be a little bit less, because we are seeing a lot of different pitch deck. We have been, we have some insight on different sectors and so on, but please do not hesitate also to be optimistic, because at the end of the day, we are looking for sustainability, of course, but we're also looking for exponential return also at the end of the day. So this is also something to keep in mind. Around this blitz scaling terminology, which is very funny for me because I don't know if there is some people that speak German, but it's a terminology that's coming from the World War II. And the German army succeeded to invade France in 6 weeks, thanks to this blitzkrieg strategy. So on the paper, it's something that works. The thing is that when we are looking at blitz scaling, we are taking a little bit too much in mind the Silicon Valley views. They have a lot of money. and there is like, I mean, it's completely different from what we have in the continent. For it to be a success, let's say a blitz scaling strategy, you need a lot of different things. First, is not every type of business that need this type of strategy. So for that, you need an innovation and something that need a network effect. So it's something that is quite, that is not common for all the different businesses. You need also a distribution advantage, and you need also to be in a market where the winner takes everything. We have different problems, and one of the opportunities that there is not that much sectors when there is like just one actor that can take everything. So it's also something to keep in mind. When you are going into blitz scaling, you also need to have a lot of resources financially. You also need to have the right team. You also need to be able to attract the good talent during the different phase of your scalability, which is something to keep in mind. You need to have the ability to move fast. And also you need to have a technology or something that is very superior and ahead of all the different people that you are meeting. So this is the things to keep in mind. Of course, the pros is that you will be able to increase the number of clients, you will be able to generate more revenues on paper, you will be able to build economies of scales, and you will be also able to create a model that can be duplicated in different geographies. But at the same time, there is some different cons. First is that there is not one African market, but there is several African markets or sub-regions. So the way that you will scale from Nigeria to Côte d'Ivoire will not be the same that you will scale from Nigeria to Benin or Nigeria to DRC, even if they all speak French. So you also need to be aware of it. The second thing is that you also need to be able to manage all the different structural problems that we will have. So just before I was reading, for example, an article of middle management crisis in the continent. It's very difficult to hire people that will be that will help you to go into the scale phase. So it's something also to keep in mind. And the last part also concerning the cons is that, as you said before, we are becoming a little bit more and even more conservative on the cost. It's because before, in my views, money was free. Now it's a little bit different. So we are quite more conservative in terms of valuation. We are more conservative in terms of the different people that you employ. So for example, if you have a full team that is based in the US, but you are operating in Ethiopia, it might be difficult for you, for example, to raise money, so that we can be able to see this, let's say, sustainable, let's say, scalability. We are not looking to have, let's say, a company that will just burn money. We are looking at a company that will be able to move and pivot their business model so that they can be close to this profitability. I'm always saying to people, don't chase perhaps the profitability now, but we need to see the path to profitability, so that if there is any fluctuation, anything that is a little bit different, you have this ability to change a little bit your business model. And to be honest, in our portfolio, we saw a lot of different innovators and great founders that have been able to switch a little bit the focus from scalability to profitability.
Thanks, Jordi. Love that. There's one thing that I want to follow up there and give this one to Karen, which is this idea of sustainable scalability, especially in the market that we are now. So Karen, I want to come to you and really ask from your side, what are some of the red flags that you have seen in the past from some founders who, not really realistic in terms of their projections, in terms of their forecast for growth and scaling? So just some red flags that you've seen and what advice you would give to founders to kind of just avoid that when engaging with investors.
Sure. So I think maybe we can start with some, well, it's not mistakes, it's learnings, I guess, even from investor perspectives, where, we were not really looking at valuations as much, trying to replicate a model, as Jordi says, that's in a different market, in a much more advanced market, from an infrastructure, from a capital, from, a skill perspective, not skill, actually, I think Africa has the best talent. But then trying to replicate a model that has been in existence for so many years, into a market that is just getting into that VC world. I think it just started growing about 10 years ago. So we're still quite nascent as well within that journey. And so what happens is you have startups which are raising at a very high valuation and are trying to justify that very high valuation by growing at all costs, which means that you're missing certain key steps in that growth process, including HR, something very simple and basic as HR. And I'm sure you've seen that with a lot of the startups and some of the news reports that have come out from a HR perspective that they have missed because you've grown so fast that you haven't really focused on the details of getting you to that growth. Looking at the markets and trying to understand first the market that you're in, make those mistakes within that market that you know very well, get deeper into that market, get your product market fit proper, pivot and understand it better before then trying to replicate that maybe from here in South Africa to Nigeria or to Egypt or to Kenya or to Benin or anywhere else without first learning what it is that what works for you, what gaps there are in those certain markets. But what happens is because of that valuation that you've set, you're trying to say, okay, fine, you know what, within the next 2 years, I have to get to this number of users, I have to get this number of revenues, so I can justify even for my next round, a higher valuation that would justify this initial investors coming in as well. So then you're always scrambling, which means you're spending a lot more. And then when the funding winter happens, which did in the last couple of years, then you don't have a sustainable business. And you see a lot of these really successful businesses that have raised significant amounts of funding not being able to survive through that funding winter. So they're not as resilient as companies that sort of are a bit more sustainable in their approach to growth. And it doesn't mean that we don't want you to grow. We do want you to grow because we are a VC fund. So of course, growth is good for us as well. But it has to be a very realistic, a very sustainable, a very well thought out growth metric or growth process that does not miss some of those key steps that will help you be more resilient when another funding winter comes. It's a cycle. We've gone through that cycle. We're still sort of within that winter period, but it'll come back again. So it's important to just know that we're still learning within the VC space as investors as well, as founders. There have been some very good success stories. There have been some good success stories that suddenly became disasters. But then at the same time, I think I'm still very optimistic about the fact that we're still in that learning phase of the VC world. And if you look at even deployment between 10 years ago and now, if you look at that curve, it's still quite significant, even looking at the last 2 years that have been a bit less in terms of deployment on the continent. So I think some of the red flags is that growth against all costs, where you're like, I'm going to expand into Namibia, into Mozambique, and you're currently operating with a few thousand customers in the country that you're in. So that's one. Not taking into account what that growth means. So you're looking at your projections and you're increasing your revenues, but then your costs are not reflecting how you're going to get those revenues. So per unit, how your unit economics are not making sense, because are you going to still operate with the same team, but then you're tripling your revenue? Is that realistic? Are you looking at per cost? What does that look for me? When am I going to become profitable to make this make sense for an investor, for the business, for yourself? And then for some of those founders, and I know it's important at the very early stage where founders say they're not going to pay themselves a salary, but then for us, it means that, okay, so how are you surviving? Is this something that you're actually going to keep, sustaining over a period of time? Or are you going to start taking, like side hustles or side gigs that then have to sustain your life? And then that means focus. Is your focus really there? So I think it's really good to take our learnings over the last few years. There's some people who've made really well, even with the challenges that we've had in the last couple of years. But then understanding that I don't believe in growth at all costs. I think more sustainable is where maybe I'm more conservative than most, but I do invest at pre-seed, so no, I'm not. But yeah, those are my views.
I think the thing that's always quite interesting there, firstly, definitely from an industry perspective, nascent industry, we are still learning as investors. And founders, we need to take founders on this journey with us, right? And it's events like this that definitely helps. Founder education is crucial. Where are founders falling short in not learning these lessons before they start raise conversations? I'm going to start that with Karen, but also keen to hear from Alioune and from Jordi. So where are founders falling short by not learning from these lessons from other founders to also just increase their chances of success when it comes to raising?
I think, because there have been some very loud success stories, So you almost sort of try and ignore the reality on the ground, and you keep hoping that perhaps my story will be a bit different. I think that's somewhere where founders are falling short. And I think on an investor side as well, I usually try to be very prudent and very clear in terms of my rejections or my not right now, a bit later. So advising the founders as well, where it is that perhaps they need to focus on before they can come back to us for an investment. If it's not a fit for us, but perhaps could be a fit for another investor, but not right now, we then advise them on, okay, maybe look at unit economics are not making sense, perhaps relook at that. These particular projections, I don't know if you've really had a look at that. Look at comparables, compare yourselves with other businesses similar, but then if it's in a different market, discount heavily because we've got other risks involved in terms of regulatory risk or sovereign risk, currency devaluation risks that then would change those metrics to localize it. And then just trying to understand as well that you need to do a lot of research around the market that you're in, understanding that very, 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 very deeply. Are you actually solving a problem? I was just about to mention one particular startup that I thought was not solving any problem in what they were doing. And true to form, 6 months later, the company was not there. So just understand exactly what it is you're trying to solve, and then be more realistic around the success stories, understand the success stories, understand the failures, understand why they have failed. I sometimes even seek out some of those failures, because I don't call them failures really, it's just learnings. Repeat founders and look at them and say, okay, fine, you started this didn't work, what did not work, what do you think worked for you, what do you think did not work for you? And even as you start another business, because I've actually recently just invested in a repeat founder after his initial startup failed. But it's not because that I thought he's a failure or anything. He's actually gotten a lot of learnings from that fail startup, and macroeconomics and others. So I think learning from other founders as well. Don't be afraid to reach out on LinkedIn and ask them, I'm really trying to start this thing, but I know you tried and this happened. Learn from everybody, learn from the investor, learn from the founders, learn from your peers, network, and get as much information as you can from the industry.
Love that. Alioune, Jordi, anything to add from either of you? Alioune, go for it.
Yeah, I just want to put off what Karen started with around transparency and communication. Ultimately, it's a relationship business. And I think very importantly, founders need to understand that, at least on our end, I will not speak for the industry as a whole, but we're not looking for founders who knows everything. And that's why it's important as well to build relationship, because it's almost more impressive to talk to someone quite early on, see the gaps, and talk to that person a few weeks, months ago afterward, and see all the progress they made, all the learnings that they've made in terms of knowing the market, the business, etc. And that's honestly how you get it done. That's how you get VC over the line. So yeah, be transparent, communicate, reach out, ask questions. Sometimes we can also help without putting money. We're not only here to put money at the end of the day. And yeah, sending reports, being concise, email, LinkedIn, like find us, but not only us, find your peers, find people building similar businesses in other geographies. It doesn't only have to be focused on the African continent. People have transferable learnings across ecosystems, across sectors, across geographies. So yeah, make sure to tap into it.
Fantastic. Thanks, Alioune. I'm going to go to an audience question, and I'll point this to you, Jordi. So this is from Samuel Kumsum. So his question is, how do we get off the MVP stage when we need, for example, licenses with financial requirements before we are able to launch a product? In essence, we cannot have traction, we cannot launch, we cannot find new customers, we cannot grow until we have raised some money in order to do this, right? So it's a bit of a catch-22. I need to get a license in order to launch a product. I need a product in order to get customers, but I need money in order to do all of this. Keen to hear from you, Jordi, what you say to Samuel.
Yeah, so I assume that Samuel is building a fintech. I don't want to guess the country, because depending on the country, there is also different things that can let's say, different parameters. But I would say that I've seen a lot of companies, at least here in Nigeria and even in West Africa, when they can and when the regulation is favorable, to be able to do some partnerships with some banks and with some financial institutions, so that they can just, lend you, let's say, their license, and so that you can be able to have your first clients. You need to be very wise when you look at who you want to work with, because sometimes you can work with actors that have a different understanding of partnership, but also on what you are building. But I believe that if you are in a country that, let's say, there is an ecosystem, a VC ecosystem, it's something that you can be able to manage. The second thing is that we, Optera Capital, I'm not speaking for the others, I'm not investing right now in a pre-MVP, except if you build something that is very different, something that is with, I mean, if you build the next ChatGPT, come and see me, even if it's pre-MVP. But you have also different companies, different VCs, different brand providers that can also provide you support. But at the same time, you also need to demonstrate that you find your product market fit. It's not just about, oh, I cannot have the license, but I'm sure that when I have the license, I will have all the different clients. No, you need to be able to demonstrate. And how is to speak with the market, to have market data, something that I learned in business school, and I was quite surprised, but that I'm not seeing that much founders doing that, is just interviews, focus group, quantitative data to just have a bit more sense. I was a bit surprised. And okay, we have a good excuse, is that we are in a continent where we don't know numbers, we don't know how many people are in different countries, we do assumptions, but this is the basics, because you cannot just be in your room saying that, oh, I identified this and I know that there is a pain point. And as Karen also said, I believe that the first reason for failure startups in Africa is the lack of market and pain point. So this is also something that you need to look at. But Samuel, if you are, I know some countries where it's very difficult to operate, because as soon as you are doing some money, they will come and catch you, the regulators. But if you are in a country that is a little bit more VC friendly, it should be doable. And do not hesitate also to look at different peers that also have been doing and trying to launch the same product in the same sector, or in a sector that is also quite regulated. You can also have some different ideas.
Thanks so much, Jordi. Samuel, I hope that sheds a little bit of light. I think also, partnerships, doing that sort of research is so undervalued from a founder perspective, but can be so valuable in terms of the insights that it gets and even the conversations. I mentioned earlier that we've launched our How to Startup Fellowship recently, and one of the lecturers there says that, he was a co-founder of Flutterwave and Andela. He has a quote that, when he, in his early stages, was interested and ready to start fundraising, he would go and speak to founders who have raised from the VCs that he's interested in raising from, and getting that learning so that he can increase the chances of his success. I think that's a very important lesson for all of us. We have 5 minutes to go. I'm going to encourage you to please add your question if you have any for our speakers in the chat. We'll definitely not get to all of them this evening, but we can do a follow-up with some written answers from our speakers. With the 5 minutes, let's do a lightning round, starting with Karen and working our way back through to Jordi. So what's one key piece of advice that you have for founders when it comes to building out their projection metrics, understanding their traction metrics, whether it's across revenue, customer acquisition, beyond what we've spoken about, which is, founder education, speaking to other founders, understanding where the failures are. So if you had to, in 1 minute or less, you're sitting with a founder in front of you, what advice would you give them in terms of telling that story around growth and traction for their startup?
Yeah, I think one of the most important, at least for us, that we look at even before I answer that, is on that the team that is going to deliver on that story or that product or that business. And so ensure that the team that you're founding this business with has a very complementary skill set, very relevant skill set, And so that when you're telling us a story that you're actually able to convert users into paying users that will believe in that business, that team actually can deliver. There's that founder grit. We know you're going to be in this for, for the long haul, through thick, through thin, through everything else. And then understand very deeply what your unit economics are and make that make sense. If you're looking at farmers and inputs, understand per input, what does this cost for me to produce? How much am I going to make per unit? Then you can very quickly, if you understand that, drop off some of those things that just don't make sense over a period of years, so that you're not investing so much time, so much money into something that does not actually make economic sense. Then understand very deeply, as I said again, the market. Understand that there's an actual problem that you're trying to solve, and not one that you heard about that was working in Israel and now you want to replicate it in Morocco. Understand very deeply that there is a problem, that the problem is significant enough that it's going to grow that business, that is going to attract investment if that's a route you want to take, because not every company needs to raise funding. Some companies are fine using revenues and they'll grow significantly and may not actually necessarily need any funding from external investors. But there has to be a significant problem that you're solving. And for me personally, I find that if you're from a particular region, you understand that problem a lot better. If you have lived in that region for a significant number of years, you understand that problem better. If you move to a particular country and 6 months later, you decide that there's a significant problem in this particular sector, for me, I'm like, how do you know that it's an actual problem and not something that's a problem to you? So for us, it's very important that there's also proximate, homegrown solutions to problems that are understood by the market that has been within that region. So I think those are some of the pointers, I guess, from my end. If you don't understand the market as much, get a local or someone who understands it so you can then build that together and be clear that there's an actual problem you're trying to solve.
The funny thing that we come across with many founders on the continent is that when we speak to outsiders, we say, Africa is a continent with many different countries, but when it comes to growing our own startups, we think we can scale from one to the other pretty easily, and we find that it's not that hard, not that easy. So things that, just to sum up what Karen has put down there, team is important. That tells a story. Know your unit economics and understand your market and the problem that you're trying to solve. Love that. Just to also point on the fundraising, we know from a VC perspective and from a founder perspective as well, it's what's important is raise when you need to raise. If there are other avenues of funding that is available to you, you should be exploring that, or it should be on your radar. VC funding is not the only vehicle. 2 minutes to go. Want to go to Aliyun and then finish off with Jordi. Your one piece of advice for founders when it comes to telling a story around growth and traction.
I think for me, very similar to Karen, but be customer-centric and data-driven. Invest in your data analytics and data infrastructure. Make sure you define clear KPIs. Make sure to refine them as you go, as you learn from your customers. We have regular performance reviews. Make sure to use your data stack to make data-driven decisions and not emotional ones. And I guess the last one, have a strong bias for execution, but also make sure to take some moment to take a step back from day-to-day operations and see how are you doing towards your end goal and your larger vision. Are you getting closer to it, or are you just running around?
That is fantastic. Love that bias for execution. Jordi, we have 1 minute left. Take us home.
I try to do even shorter because I've been getting very great insight. The thing that I will say first is keep it simple. Just keep in mind, what I'm always saying to people is that keep in mind, let's imagine that you are speaking with 5-year-old kids when you're explaining everything. And if you miss anything, or there is like during 1 hour, the person is not able to understand your business model or your metrics, it's not that is not intelligent enough. It's that because perhaps you didn't did the work on making it very simple. And it's the same on the metrics. Sometimes I'm discovering metrics, to be honest. And like, is it really something that will help you and help me that I believe. Also something, and I believe someone also asked that question, is that keep in mind also that I think these investors are becoming a little bit more like PE investors, which is good and bad. Good because now we are relying a little bit more on figures. Before that, it was about like, yes, the dream, the TAM. So everybody was saying to, yes, you know, I'm going in Nigeria because Nigeria is 200 million people. And, you know, I can create like bank account for everybody within 18 months. Now we are a little bit more different because we have been, let's say, growing and seeing also the different lessons. Keep that in mind. And also one of the things is that we are also here to help. I know Allium, so it's easy, and I know their portfolio. I know that is working a lot on the portfolio support. I'm sure that Karen also is doing that a lot. And we are here to also help you to build that, because at the end of the day, to be honest, my interest is that all the sustainable companies can raise money, not necessarily from Optera Capital, because sometimes you just don't have the money. Let's say much more companies that are coming that will be able to generate revenues, new business model, and that can also create some exits for the market. So please do not hesitate also to ask for support of different people when you can, and it's good to have initiatives like the one that you guys are doing right now. I believe it's a great opportunity to have a lot of different learnings and also to be able to identify what we are looking for so that you can also be able to attract funding.
Fantastic note to end on this evening. I want to thank all of you for joining us in this conversation. Thank you so much for all of the questions. Unfortunately, we didn't get to all of them, but we will definitely be doing a wrap up after this, so keep an eye out for that email. I want to give a special thank you to Jordi, Alioune, and Karen for joining tonight. We've run over 2 minutes. My humblest apologies, but this was a jam-packed, just insightful conversation. Keep an eye out for the post-event mailer. We'll try and surmise some of this and also on our social media. And then I've dropped the LinkedIn links in the chat. So if you want to connect with any of our speakers, please go ahead and do that. Thank you so much for your time. I look forward to seeing you at our next event. And thank you so much for our speakers for your time as well. Have a good evening, everyone. Bye.